Let's bring in Chevron Chairman and CEO Mike Wirth. Mike, great to have you here. Thank you so much for joining us. I want to start with your revenue number, because when you look at your quarterly report through that prism, year over year, the jump is pretty historic. You know, the world a year ago had stopped due to COVID restrictions. What is demand like today compared to, let's say, the pandemic low point?
Well, it's come back significantly. As everyone recalls, during the low point, economies in the United States and around the world really were locked down. People were staying at home, and even, you know, we'll remember the shelves sometimes weren't filled with the goods people were looking for. So we've seen a strong recovery from that, and yet not a complete recovery.
And the current quarter, if I could ask you about that, because as we look at what demand was in the most recent quarter, how much better or neutral or worse does it look? Can you give us an idea?
Well, it's a path of continued recovery, really. And I think in the most recent quarter, we don't necessarily see what some people worried about was this latest coronavirus variant having the effect of kind of pulling economies back to where they were last year. We really do see continued progress, and it's a little different in different parts of the world. But broadly speaking, it's a story of continued economic recovery, and certainly as we move into 2022, that picture holds.
The surprise 6% dividend hike to what, $1.42, that came out before your numbers. That really caught the market's interest and investors' interest. The dividend increase and the company's existing share repurchase program means Chevron is going to distribute, what, more than 40% of this year's cash flow to investors. At the same time, your CapEx isn't exactly electrified. How should investors interpret that?
Well, I think they should, first of all, understand that we had another record quarter and a record year when it comes to cash flow. So the fourth quarter was the second quarter in a row where we had all-time high free cash flow. And for the full year of 2021, our cash flow was 25% higher than the highest year in our history. So we're generating strong cash out of our business, and more of that is being returned to shareholders. A 6% dividend increase. We're able to reinvest in our core business and keep it very healthy, and return even more cash to our shareholders.
And believe me, shareholders don't complain about that. But I want to take you back even well before the pandemic. You're a very long-time employee at Chevron. When you took over as CEO in 2017, where back then there was an oil glut and a collapse in prices. Now you're dealing with the exact opposite scenario. Oil hit $90 a barrel earlier this week. And I mean, you look at Wall Street's $100 a barrel forecast by this summer, that suddenly doesn't look so lofty. What is your price outlook for, let's say, the spring? Forget the summer, the spring. And Americans, even though they're still not driving as much as they did pre-pandemic, what are the factors that would push it to $90 or more right now?
Could we see $100 oil? I think we could. We're not far from it right now. And a lot of it depends on things that are very hard to predict that could happen around the world, which is why we stay focused on the fundamentals of safe and reliable operation, efficient execution of our capital spending and our projects, and in meeting the needs of our customers for our products. We are in an upcycle. There's no doubt about it. We're coming out of a period of time where demand had collapsed, and there was concerns that there was so much supply we wouldn't have places to store it all. And so during 2020, supply had to contract simply to recognize the fact that the demand had collapsed so significantly. And as this has turned, we're seeing that supply now is struggling to keep up. Inventories have been drawn back down, and we are seeing that reflected in prices. And of course, we also now see geopolitical concerns, such as those related to Russia and Ukraine, are once again creating jitters in commodity markets.
Mike, bringing up Ukraine and Russia, I'm glad you touched upon that. Obviously, any kind of increased tensions could hinder supply more than they've already been crimped. Have you been asked by the Biden administration to prepare for that possibility? And if so, what would you do? Increase natural gas production? Let our viewers know.
Well, I really won't comment on discussions we have or haven't had with the administration, but I will say we're always planning for contingencies, and things happen. We operate around the world, and so we're exposed to events every day in different parts of the world that we need to be prepared for. Safety and the security of our operations is obviously paramount. And then you do look for circumstances where you may be called upon to try to do more. The reality is, in this strong market that we've seen, the incentives are for all producers to be producing as much as they can because the demand is clearly there.
Well, this wouldn't involve private conversations with the administration. President Biden outright has criticized publicly U.S. oil majors for spiking retail fuel prices. In a letter to the FTC, the Federal Trade Commission, he noted that you and Exxon were on track to double your profits while American families are paying more at the pump. Now, clearly, no one was complaining when oil and gasoline prices had cratered 5 years ago, and you guys had to shoulder that. And yes, complaining about this situation right now does show a pretty much complete lack of understanding about the boom and bust cycle you guys always endure. But what is your answer to that if, you had to face the American people and explain why they're paying so much?
We're a very small player. We're 2% of world oil supply. It's a very large market that trades on commodity market fundamentals, and the prices reflect the supply and demand in the world. And companies like ours do not have the kind of market power that is suggested in the letter that you referenced. A year ago, we lost $5 billion. This year, most recently that closed, we earned a profit again, and those numbers reflect economic circumstances around the world and commodity markets. And if we want to see lower prices, what we really want to see is more supply, and we need policies that encourage investment in supply. And this is a country that's an energy powerhouse. We're the largest producer of oil and gas in the world, and can be for a long time to come if we're allowed to responsibly develop those resources.
Well, that brings us to the breaking news from last night, right? Federal judge blocked $190 million of gas and oil leases the Biden administration had auctioned off in the Gulf of Mexico, saying that the government didn't adequately study or offer a detailed analysis of the environmental impact. So the auction right now is dead in the water. You guys spent about $47 million. You're the biggest spender. What does this ruling mean for the company?
We're studying the ruling because, as you mentioned, it just came out, and we were not a party to this legal challenge. We've got a very large position in the U.S. Gulf of Mexico today. We like the leases that we bid on in this sale to further strengthen that position. This is an important part of U.S. energy security, and frankly, the Gulf of Mexico production is some of the lowest greenhouse gas production in our entire portfolio. So we believe that American energy can and should be developed responsibly for the energy security of our country, to create jobs and the economic vitality that comes along with it.
Before we go, the ESG movement appears to have a little bit of staying power here. Last October, Chevron pledged net zero operational emissions by 2050. Can you please, both shareholders and climate activists, and when will your renewables business begin to really contribute to earnings?
So we outlined some goals for our business to reduce the carbon intensity of our operations, and importantly, to grow new energy businesses alongside our existing businesses. And so we laid out very specific targets to grow our renewable fuels business. So that would be renewable natural gas, diesel, sustainable aviation fuel. We laid out targets to grow hydrogen production and have aspirations to grow both blue and green hydrogen, which are low carbon hydrogen sources, carbon capture and storage. How can we actually take carbon that's being emitted and secure it and store it so it doesn't go into the atmosphere? And so we laid out $10 billion in spending for these lower carbon initiatives over just the next few years, and are working a really robust pipeline of opportunities today, and have made some announcements. We're selling renewable natural gas. We've delivered our first sustainable aviation fuel to one of the big airlines, and I think you'll see in the in the
Nice.
quarters and years to come. Further progress on this, it's very exciting. We've got a great team of people working on it, and we see it as an important part of the future in creating a lower carbon energy system.
Yeah. Well, you guys are evolving, and that's what shareholders, I would imagine, like to see. Thank you so much for joining us. Michael Wirth of Chevron.